All right, why are rates going up? Why are they not going down? I was on the boat that by the end of this quarter, we would start seeing rates down. Everyone predicted rates would go down because inflation would go down, and rates follow inflation. So as inflation goes up, interest rates go up. As inflation goes down, interest rates go down. And today was a great example. We saw inflation down to 2.9% month over month from the previous month, which was 3.5. Why are rates still crappy, right? And this is the best thing I could say is the Fed keeps moving the goalpost, right? At first, the whole last 18 months is inflation's out of control. And I totally agree with them. They had to raise rates. Rates were too low. The cost of everything was too much, and people's income was not catching up to what inflation was. So they had to do something, and they had to raise rates. Now, did they raise them high enough? Yeah, I think so. Are they done? I pray they are. But what's happening, though, is the inflation is going down for the numbers. They remove groceries, and I think what's the other thing? They remove two things in inflation, and then everything else.
Energy, right? Isn't it
Energy? Yeah, that's what it is.
Basically,
gas
prices.
Yeah. Basically, energy and food they remove, which food honestly is so expensive. I don't know if anyone's gone out to eat. Like, we're making food at home because with a total of 4 or 5 of us in the family, right? Well, really, the kids eat like adults now. But anyway, it's so expensive. I hate going out to eat. You can't get out of a bill of $200 or less. So going back to this, with the Fed, they're saying that the economy is so strong that their second indicator is going to be jobs and job growth and unemployment. So inflation's back to what they wanted. They said when inflation gets to 2 to 3%, they'll start lowering rates. Well, we're there and they're not lowering rates. They're talking about potentially another rate hike. And by them just saying that, it's already spooking the market. We're already seeing interest rates at 8%, which I've never seen in my career, right? I've been in this since 2001. I've not seen rates this high. It's definitely having an effect on the economy and housing and everything else. It just takes time. So now the new goalpost that they created was job reports and unemployment, right? And now the job report came out last month, 390,000 new jobs. Okay. And so the Fed goes, the economy's rolling. We're as strong as we've ever been. Dissecting the 390,000.
What happened that day, Chris, when rates what happened to rates when unemployment showed 372,000 new jobs? What happened?
I don't know, half a point in rate. It was nasty. It was like doomsday as a mortgage person, right? It was nasty. But here's what's crazy, though. So here's what's interesting. Out of the 390,000 new jobs that we inherited, we actually lost 72,000 full-time jobs. I want you to think about this. 72,000 full-time employees were actually laid off on top of the 390,000 new jobs. So that's really 460,000 jobs that they said we added. They ended up being seasonal workers and people getting second and third jobs. So it is being manipulated 100% by the Feds. And a lot of everyone's saying is, hey, look, rates are going to come down because it's a presidential election next year, and the Feds are going to want, to keep rates at a level so they can pound their chest politically and say, hey, we did a great job. You got to realize something. Jerome Powell's in chair until 2026. He ain't listening to anyone but himself. And so it doesn't really matter, right? So that's something that we have to keep an eye on. When is this going to happen? We'll talk a little bit more about that. But right now, they moved the goalposts. Inflation was the number one factor. Now it's coming down. Now they're like, the economy's too hot. We have too many jobs. They literally, go to the next slide, Josh. They literally are, Powell knows the labor market and economy growth may need to ultimately achieve the Fed goal, right? The Fed goal is to slow this down, right? And we're finally here after 18 months of increases, but they still are saying that unemployment's too low. They want less jobs, more unemployment. And once they start seeing that, they're going to come back and go, okay, we're going to start cutting or lowering rates. And we got a while. I don't have the crystal ball, but it could be 6-8 more months of fun. This is real fun, right? And so in the interim, what are we starting to see today? Although inventory is historically low, demand is also low. A statistic came out 2 weeks ago that demand is for mortgage applications to buy a house is less than 1994. Okay. I want you guys to think about this because you're going to start seeing what I'm seeing. I've been pounding my chest for 4 months saying the market is going to shift overnight. Be prepared. And we're starting to see it. Every listing sitting, right? They're not all, but most of them are sitting. And so, yes, our supply is very low because demand was super high. People were still buying at 6-7% rates. I think the 8 is probably put everyone into shock. And now inventory stacking. What was the statistic in Long Beach? Over $1 million. We have 4 months of inventory now. 4 months of inventory when we had less than 30 days, 60 days ago, right? So you guys are going to start seeing this. The 30-year fixed increase for the 6th consecutive week to 7.7, the highest since November of 2000. We're probably in the 8s, right, Josh?
Mm-hmm.
We're 8s, right? The 7.7 has points and fees and crap, right? Okay. So this is what we're going to start seeing, right? And what does this mean right now? What it means is the buyers have all the control. The listings, if you're smart, you're throwing out the comps and telling people, hey, I know this home sold and it's bigger and better than yours 60 days ago. We're in a brand new market. No one has seen, not just 7, no one's seen 8. So that's something I want you to be aware of. As we move forward, I think it's going to be a heck of a time to be a buyer. I think being a seller is going to be very difficult, especially in the higher end. The lower end, I still think you're going to be able to get multiple offers if you price it accordingly. But if you're on the low, if you're on that at million and above right now, it's a tough market because great example, I have a client, 1.13 purchase, 20% down, golden client, jumbo, the whole 9 yards. Rate was 7.375. His all-in payment was $7,500 for a 3-bedroom, 1 bath, Belmont Heights, right? 1,200 square foot home, or maybe it was even less than that. And he literally goes, I can't afford more than $6,000, right? And so that's what we're running into is affordability. So all the doom and gloom's over. What do we do now? How do we get the buyers to move forward and get the sellers to recognize what an affordability issue we're having? And I'm going to show you this in this one quick slide. If your seller, you're having a conversation with your seller about price reduction, have a conversation about credit. And you guys, you'll see it on the MLS. You'll see like sellers willing to pay $20,000 to buy down rate. Sellers willing to get you a 3-2-1 buy down. That's the stuff that's moving. That's what builders do. We need to be builder listing agents. We need to have incentives for buyers to buy our home versus the house 3 blocks over at the same price. And the only way to do that is you got to offer creative financing. And Josh will get into that, but I just want to show you guys the numbers because the numbers tell everything. I took $1 million purchase right here. Option 1, following along. Josh, put your little pointer up there. Right, there you go. $1 million purchase. That's me. 800 loan amount. I used a rate of 7.5. It's probably higher than that now. But anyways, APR 7.5. Their total payment is $59.93. Great. Okay. No activity on this house. They want to get a $20,000 price reduction. Okay. What does that do for a buyer? It saves them $91, $93, $5,481 for $20,000 off the purchase price. That's not moving the needle. Okay. But what if that seller goes, you know what? I will give the $20,000 for a rate buy down. And this is where I'm pounding my chest. Option 3, $1 million purchase. They were willing to give $20,000 anyways off the purchase price. Why don't we give the $20,000? What's that?
That's the payment difference.
Oh, wow. Okay. Thank you. So option 3, the seller gives a $20,000 price reduction or $20,000 for us to use for closing costs. The new payment now is $49.90. Okay. With 20% down. What was the savings, Josh?
$602.
That moves the needle. Right? If I'm a buyer, I'm buying at $1 million price range and $5,600 is too much, but I could get a payment under $5,000. I'm going to do that. That's that same $20,000 price reduction versus a $20,000 credit. This is why it's very important to work with us when you have buyers and they're payment sensitive and we're going after a home that's not beautiful, not just brand new on the market and has 10 offers. This is a strategy to show buyers. We use this same strategy right here on this sheet right here and go, listen, if you still offer the $1 million, but they're going to give us 20 grand, look what your payment is. This is I have a handful of deals in escrow. Josh has a handful of deals of escrow. Seller credit on every single one of them, price reductions on every single one of them. But it's us taking the credits and going, would you rather have a payment or would you rather have a lower purchase price? 10 out of 10 chase the payment. And honestly, it's payment anyways. Like no one really cares about the difference between a $980 and $1 million purchase. They care about $600 savings. So this is huge. If you have listings that are sitting, reach out to us. We could put together some 2-1 buy downs, 3-1 buy downs. Super easy. We have a calculator and we could tell you exactly how much seller credit. You go back to the seller and go, listen, our home's not moving. And most people are going to tell you to do a price reduction. I'm going to tell you to do a credit. I will advertise it on the MLS in the note section saying seller is willing to pay X amount of that, what would have been a price reduction to get you in a range of X. And we could show you many examples that are on the MLS right now. And those homes seem to sell a lot faster. So this is my strategy right now is 100% seller credit. All right, next one, Josh. I think it's you.
That's me.
All right, go for it.
Okay, so next one, let's talk about FHA versus conventional. So for the longest time, we did everything we could to get our buyers into the conventional bucket, everything we could do to go high balance, whatever, stay out of the jumbo space, because conventional was king. That was the best option in town when it came to pretty much most of the deals out there. Stay in conventional, stay in conventional. FHA made a couple of tweaks recently, which have made it more attractive. So one, the FHA loans continue to have the lowest rates that are on the market, that are available on the market right now. They're even better than jumbo rates and they continue to be subsidized. So we have that going for us. And the second thing that happened was they lowered the mortgage insurance. So mortgage insurance, I forget, Chris, you remember when it was when it jumped up?
It was all the way to 100 basis points, basically 1%. And then they moved it to 85, but it depended on your loan amount. So now what is it, a half now? 0.5%?
Yeah. So if you're in the typical low balance, like 726, which is soon going to be 750 and lower, you're looking at 0.55.
So that's cheap.
So conventional is very heavily, mortgage insurance is very heavily weighted on your credit score and your debt to income ratios. FHA, it's just flat. It's just a set 55.
Doesn't matter your FICO score, right? You can have 600 or an 800 FICO. It doesn't matter.
Doesn't matter. So having lowered those premiums by anywhere from 0.3 to 0.5% and having those subsidized rates, it's really made FHA kind of the way to go right now for a lot of our buyers. So I've got two scenarios here. I want to kind of highlight the fact that FHA is not just first-time buyer. It's not just the low loan amounts, that type of thing. So looking at this, you've got a conventional, and again, this was a few days ago, so the rates are even higher than this now. But looking at this here, you've got a conventional 5% down. I think we can open it up and can you guys see the
I can see
full screen now? So we've got conventional financing here, 5% down. You're looking at a payment of $5,031. We've got the same 5% down FHA, lower rate, and we're looking at $4,400 a month.
$590.
There you go, $590 right there. Same property, same thing, same everything. But dollars to dollars, it is adding up in terms of savings, right? And then
this
look
is
at
because,
$1 million.
Josh, because mortgage insurance up monthly went down and the interest rate on an FHA is much lower than a conventional loan, correct?
Correct. So you can see the mortgage insurance here kind of broken out. And on the lower one at 5% down on the lower loan amount, they're virtually the same. Wow. If we jump over here to $1 million, you can see on conventional 10% down for $1 million, it's still cheaper to go with mortgage insurance on conventional financing because this is that higher tier. However, you've got almost $1,000 payment difference in monthly payment of the principal and interest because of rate. So if we go back here, we're
We're
looking
going to
at
see a lot more FHA then moving forward. Okay.
a lot more. So keep that in mind. That's definitely something that we're going to see is going to be FHA. We're going to have these conversations with buyers on FHA financing. Things that we need to look out for on FHA are going to be chipped paint chipped paint and cracked tiles. Those are two big things that FHA calls out. We don't want to have any peeling paint, any lead-based paint issues or whatever. That's really big.
But
So
what
property,
most of the time, Josh, that gets fixed by termite anyways. If there's a termite, if you write termite clearance and they do the clearance, most the peeling paint gets primed anyways from the termite company when they do that, right?
right? And no appraisal waivers. I mean, it's definitely going to be a full underwrite, full file to go FHA, but it's saving clients a lot of money. And so we're having those conversations with people who maybe weren't thinking FHA was an option, maybe even at 10% down, because they're really like, I don't want to pay the mortgage insurance as much. So definitely something to consider is comparing FHA financing to conventional financing. Condos, something to keep in mind, they are harder on condos because we know they do have to be FHA approved. We do have the ability to do spot approvals, but that's not that's not guaranteed to have to be completed. But condos are something, and then loan limits. We got to keep an eye on the inland counties. So you move to Riverside, we dropped from 1,089,000 to 644,000. So that's something we don't want to get caught with.
And Melissa asked a question, can you refinance FHA? And the answer is yes, you can. So you have two options, Melissa, on FHA. You can do a streamline where it's no appraisal, no income. You go from FHA to FHA, assuming rates drop and assuming values. Like if I bought a house and I paid $750 for it, and a year from now it's worth $750, you're not going into another conventional loan because you just don't have enough equity. FHA allows what's called a streamline, no income, no appraisal, nothing, and they just lower your rate as long as rates are lower. So that's a really good option. Now, let's say I bought now at $750 and prices go to $850, and a year from now rates drop. I can go from an FHA straight into a conventional with a refinance. I need an appraisal. I got to show my income. But these were big. So FHA during the last 2009, 7, 8, 9, 10, 11, 12, I was the king of FHA. I used to tease everyone. I did more FHAs than anyone else because the 3.5% was so much better than a conventional loan, and the pricing was better rate wise, and the MI was super low. This is the same MI when we needed to spark the economy last time we had a downturn. And this is what we're seeing again, right? FHA is coming back going, listen, we're here, come use us. And they've had such a bad rap, right? Everyone's like, oh, it's like a home inspection. No, it's not. It's peeling paint. It's safety and health issues. Here's what's crazy is conventional appraisals are just as bad as FHA now. If we see anything like a broken window or stairs, there's 4 stairs off the back and there's no railing, right? Conventional is calling it out anyways. So that's why I told everyone, I go, listen, it's safety and health issues. I'm going to get that same call on a conventional versus an FHA. Now, the other problem is people are like, the house is really dated. It sucks. It's not great. FHA they're not coming in saying, this is ugly. You have a 1970 kitchen. They're only calling out safety stuff. They can't go in and go, the kitchen's ugly, right? That's not how it works. So there was a lot of misconceptions with FHA over the years. It is a lot easier, and Josh has a lot of pull with his FHA appraisers. So
yeah, we got a lot of room with that. I definitely think this is probably something that we're going to see. We also should, here starting in December, get the new FHA loan limit. So keep an eye out for that. We'll email that out once that comes in, and have that ready to go for you guys. Let's talk about a little unknown niche in the FHA world, and that is going to be an adjustable rate FHA loan. What? So we have the ability, I think I can take you to the full, oh, no, not on that one. So we have the ability to do a 5-year fixed FHA. So this example was from just this, actually this was from today. So this is actually live pricing from a deal I'm working on today. And so these are both FHA scenarios. So this is comparing an FHA 5-1 paying 1 point versus an FHA 30-year fix paying no points. So you can see here that interest rate is 6.625. And again, this is today.
5.8 better.
And then the 30-year fix at no points is 7.25. And the 30-year fix at 1 point is barely better than the 7.25. So this is something that we don't see. Now, historically, these loans have not been priced very well because of the risk. And so we do have some investors who are coming back into the market and offering short-term FHA loans. So these are for our buyers who are looking at this to refinance in the next 5 years, get that 30-year fixed, and just have that lower monthly payment. We're talking about monthly payment. Here you go. You've got another $178 a month.
200. It's basically $200, right? Yeah. It's like 199.
Yeah. So
199.
now the FHA or the 5/1 does qualify with a higher rate because it is there is room for it to adjust. So this is not for our buyer who were really tight on ratios. So if we're looking for that buyer where we really need to push because maybe student loan debt, we really need to push what those ratios look like. This is not for that buyer. We need some room in the numbers, but I've got one right now that we're in counters on, and the only reason she's moving forward is because she can get 6.625.
Yeah,
So,
when everywhere you read rates are 8. So Josh, and correct me if I'm wrong, first 5 years, 6.625 is fixed, 60 payments of that. Anytime during this time frame, they can refinance. If rates drop, they can streamline into a 30. As long as rates are lower, they could refinance. If value goes up high enough into a 30-year fixed conventional. But let's assume rates stay high for the next 5 years. When it adjusts year 6, how high can it go on year 6?
1%.
So worst case number in 6 years from now, they're 7.625, which we are right now.
Which, yeah, they'd be paying more than that on a conventional if they were getting a conventional loan.
So really it's a 6-year fix, right? First 5 years at 6.625, the number year 7, 7.625. Okay.
Yep. No prepayment penalties. You can refi, try to get that 30-year fix. So
got it. This is great. So young professionals that are new in their career and their income's going to continue to grow, but they just need that extra couple $100 savings to move forward. This is a great product.
And then it's not very well known. It's always been on the guidelines, but not everybody's doing these. So
well, because we've never seen pricing on it. It's always been the 30-year fix has always been better than an ARM. So this is the first time you're hearing that an adjustable rate is lower.
Yeah. All right. So I want to tell you a success story. So we like to talk about success stories. P&L loan. So this is for our self-employed buyers. Anybody self-employed on here? Probably. So self-employed buyers, this is for you. So we've had bank statement loans for a long time. That's been, we've been beating the drum on bank statement loans. So tell you a quick story. So I had a buyer this summer who was looking to get a loan. They self-employed, and they sent me 12 months bank statements. I said, well, I don't really like what we're seeing here. Send me another year's worth of bank statements. What happened when we had the bank statements analyzed was the income was not consistent. Anybody else relate to that on this call, right? So are you seeing where I'm going with this? So we have bank statements coming in, and we're looking at these, and they're just not consistent. There's money coming in, but it's not every month. And underwriters, they want to see that consistency coming in, right? I had another one this summer that was a restaurant owner. So they owned a Mexican restaurant, and they had money coming in every month, consistent. We went bank statement, no problem. But these other buyers, it wasn't consistent. So I said, okay, send me your P&L. Let's look at this. So they sent that over, and it was a really healthy P&L. This client was an author. So they were working on timelines that had to do with themselves, right? It was their own timeline of when they were going to get completed with their project. And so because that income was inconsistent, we were able to get this loan funded, and they bought a home in LA because we were able to do a P&L loan. So the couple things with it, it does have to be signed by a CPA or licensed tax preparer. So it can't just be a P&L that you pull out of your backpack and say, here's my P&L.
It's got to be by the CPA that files your taxes.
It does not. have to
Ooh,
be by the
okay.
CPA who files your taxes. So it needs to be done by a licensed tax preparer.
Okay.
Does not mean a CPA. So a CPA is a licensed tax preparer, but there are licensed tax preparers who are not CPAs. So we got to have that. And that has been a roadblock to it. This product's been out for, I don't know, a couple of years, but it not having CPAs or licensed tax preparers to participate in that has been a challenge. So we're starting to see that loosen up a little bit. And I did fund an actual P&L loan. So that was kind of cool to see that go through. And again, it had more to do with the consistency of the income than it had to do with how much income there was. So definitely something to consider. But we got to find deals where we can find them. We got to find transactions where we can find them. And it's things like this that are going to make, that are going to make transactions happen. Jumping. Oh, let's talk about buy down. So Chris talked about permanent buy down from the beginning, right? So that was spending that $20,000 and buying down that rate as low as you can to really take after it. What I want to do is talk you through a couple of price points and show you what the client's looking at with this payment. One of the things I like about the buy downs is it's kind of an on-ramp to getting on the freeway of homeownership. So this is your warm up. This is getting there, right? If we're looking at an $800,000 purchase right now with 10% down, clients are looking at $5,000 a month. Okay, this is something that you can take back to your seller and say, hey, look, this product now, Mr. Seller, what do you pay per month to live here? What's your monthly payment?
Less than $4,000.
The guy who's going to buy your house, the family who's going to buy your house, whoever it is, this is what they're looking at monthly payment wise. This is why we need to be payment sensitive to what's going on with our buyers, because they are payment sensitive. They're sensitive on rates. Inflation's been tough. It's been a tough time for us. So looking at this is that on-ramp and having these conversations with the seller. We can prepare these exact same things for you. So this is an $800,000 purchase, 10% down. This is a 2-1 buy down. So we're going to take the actual rate today is going to be 7.5. Your actual payment is really $5,034 a month out the door. What this is a monthly subsidy. So the seller's going to give you a chunk of money. Here we see it, $17,156. That money's going to sit in a kitty. That money's going to sit in a separate account. And every month, the mortgage lender is going to collect $5,034. But for the first year, you only have to pay $4,088. Then from this account, they're going to take $946 and send it over. So your full payment's being made. Then the next month, same thing. Buyer's going to pay $4,088. Then they're going to pull from this account and subsidize that one for the year. Year 2, buyers ramps up a little bit more. They're paying $4,500. And then that money comes out of this account. The cool thing, and the reason I like this one, is that money is the buyer's money. Now, Chris, what happens to that money when they do a permanent buy down?
Gone.
It's gone. It's spent, right? It's done.
So Josh, this is a great example. Got a buyer, they go 800, they do the 2-1 buy down. They're 6 months into it. They paid $4,000 and interest rates go to 5.5 permanently. Okay. They've put $5,000 of the 17,000 already on the mortgage payment. So there's 12,000 sitting in this kitty. When they refinance it, that money could be applied towards the principal of the loan or cover closing costs, which closing costs won't be that much. So they would actually have a reduction of the principal of the mortgage plus their closing costs covered with the money in there. Correct?
Correct.
Yeah, it's a killer deal, especially if we believe rates are going to come down in the next 24 months on this scenario.
Right. This gives somebody 2 years worth to, one, get their personal income up, where they're making more money 2 years from now than they are currently. And then this gives them the opportunity to refi at any point in time. There's no prepayment penalties, and that money is theirs. It's in their account. So let's say, okay, cool, that sounds great, Josh, but I can't get $17,000 out of the seller. What can we do? Well, we can do, instead of a 2-1 buy down, we can do a 1-0 buy down. They need a cooler name for that, but same thing. So this is going to take $5,800 and subsidize that monthly payment.
And we see that on every transaction, minimum $10,000 right now at these price points.
Right. Easily. So you say, okay, cool, that's great, Josh, but I'm not selling at the 800 price point. I'm looking at $1.5 million. Great. We have jumbo investors that are doing this stuff all day long. So you got a rate of 7.75%. We're buying at $1.5 million. I did it at 25% down. We're not typically seeing our $1.5 million people at 10% or even 20. Usually they're selling something to buy this. So kind of gave you a little bit of a different number here. But if you're buying at $1.5 million, 25% down, you're looking at about $8,000 right now. So you can see year one, we're at 6,500. So that payment's $1,500
That's
less.
doable. That moves people to move forward. 6,500 on $1.5 million purchase all day.
Right. And then again, so now we're looking at 30,000. So if you're talking to your seller about a credit and we're in this price range, look at the impact that $27,000 has on that buyer's monthly payment versus a $27,000 price reduction.
$110. So instead of $8,059, their payment's $7,940.
Yeah, who cares?
Yeah,
It's
no
still
one's
$8,000.
Yep. Got it.
So that's a huge one. And then here we've got the same thing on a 1-0 buy down. So again, maybe we can't get 17,000 out of them, but we're going to be able to get a higher number. So that can definitely be something that we can see happening here. And again, this is that subsidy. So if they refi after that time, no issues there. Couple of other items I wanted to
the new
highlight.
Fannie Mae. This comes out right in about 20 days.
So we can officially originate these. So we can officially start them. They have to close after November 18th, which at this point they probably will anyways. So purchase loans and refinances, owner occupied units. So oftentimes we have people coming to us saying, hey, I want to buy units, but I need to get a FHA loan, which is fine for one, or which is fine for a duplex. But when you get to 3 units, FHA has a rule about sustainability. And in Southern California, these properties are not sustainable. They're not self-sufficient. They don't pay for themselves every month. And so FHA won't really allow on 3, or won't lend on 3 and 4 units. So we've been stuck with, you can see what used to be on here. So 2 units on a duplex on conventional was 15% down. 3 units and 4 units was 25% down. Owner occupied. This is you still moving into the property and living on the premises with units. So FHA has, or excuse me, conventional, Fannie Freddie have said, that's it. We're going to go 5% down. The mortgage insurance companies are fully on board, ready to go. We can originate these right now, and we can close, November 18th. I've got clients right now that are looking in Kern County. It's a brother and sister. They have been shopping for a duplex. They're limited to a 615 loan amount for FHA, even for units in Kern County. Super low FHA limits up in Bakersfield. And then if they get to 3 and 4 units, those numbers go higher, but they're not self-sustainable. So we get into this whole rat race. So now, yesterday, I sent them pricing rates, gave them a payment scenario on this exact program. So 5% down, buying 3 units. Their purchase price went from 600 to 800.
That's awesome.
And then that allows for more stuff to, higher price properties, higher rent to come in.
So you need 6 months reserve for it, and then gift funds allowed for down payment. What about reserves? Oh, wow. So mom and dad can be house hackers, give you your 6 months reserves, your 5% down, and they technically own the house with you on the side of the deal, and you're buying a 4 unit. That is smart.
Huge.
So you got kids going to college, right? Buy a duplex, put 5% down, right? Or a kid in college, got a part-time job, as long as they got a social security number.
Yep. Owner occupied for the kid. Absolutely.
Yeah. So do they allow non-occupant cosigners?
Yes, but there's rules about how the income is kept. If you have a non-occupant cosigner, I think you don't get rental income or something like that. So there's something about non-occupant cosigner. So I can dig into that.
But long as, we need to look at that, because that could be a huge niche, especially parents that have kids in college in their 3rd or 4th year. I mean, rent is so crazy at dorms and stuff. And you go, hey, why don't you go buy a triplex, right? 5% down, and then freaking put your kid in there and fill that thing up.
So this was the one that I was talking about here, up in Kern County, showing us at 7.99%. $6,800 a month, and this was estimating $3,200 a month in rental income coming in from the two other units,
Mhm.
1,600 each, conservative, and then their net payment is still better than if they were buying traditional.
That's awesome. Good job, man.
So one more thing I want to highlight, and then we'll open it up for questions if anybody has any. So the next one I want to highlight, I really want to talk about the equity state, or the state of equity for homeowners in the US, in the greater population at this point. So if we look at the 124 million US households in this country, 82 million own, 42 million rent. And this is a breakdown of how much money people have saved, how much they have actually in the bank. So 59% of consumers out there, 59% of households, not just individual people, have between $0 and $10,000. And then you can see it slides down from there. 0.1 have more than 5 million in the bank, and it just kind of like goes on along the way. So Josh, who cares? What does that matter? Well, if we look at historically, this is loan to value, okay? So this is not how much equity they have in their, this is showing us that 100% line, that line across the top, this is the value of their property. This is what it's worth. This line is the percent that the loan is. So essentially, we are used to seeing appreciation go up. This one's pointing down, and that's because it's showing you the growth in equity. That's showing you how much equity has been gained over the years. Now, in 2008, there might have been a little housing crisis that happened. We can see that over time, values have remained strong, and they've come back in a way that right now in 2020, the last time these statistics came out, we had the greatest amount of home equity for anyone ever in the history of time ever.
So
What does
simple
that
numbers.
mean?
If this was every home was $1 million, the average balance would be 420 grand.
Basically.
Okay.
Yeah. And back in 08, if the house was worth $1 million, everybody owed 810.
Yeah.
So basically, the equity has doubled in that span of time. In the last 18 years, we've seen a massive growth in home equity,
Right.
which is one reason that I think the market will stay strong. Even if people do have to sell, they're going to make enough money to move on. But ultimately, what we're talking about here is that it's time to look into an equity line and tap into that equity. We're uniquely positioned where we've got the ability in all 50 states to lend in home equity. We also are able to do the 3 different product types. You can do primary residence, second home, and investment property. You can get an investment property home equity line up to 70% of the value, as long as you have a 720 credit score, cash out right there. It's accessible for 3 years. And then you've got 27 left to pay it back. That's on the investment property. Typically on an equity line, you're seeing 10 years of availability of using it as a credit card. You can go back and forth on it. Right now, I personally have 2 of these going on right now. One of them is using it to buy land in Arizona. And then the other one is cashing out some money from an investment property to purchase here in Orange County.
Smart. I think it's great. I think that the fact that you could do non-owner HELOCs on investment property, because most people on their investment property have a rate in the 3s and they have a ton of equity. And when they call me, I'm like, there's nothing you could do. You're not taking cash out and getting 8% loan. That's just stupid. Right. And so the fact that you have the ability to tap into the equity, yeah, I'm sure the rates are friendly. They're 10%, but it's probably better than a hard money loan. They can use that to go buy the next one. So agents on here, you have a huge database. They own rental properties. They want to buy another home, but they're like, don't want to pull their stuff out of the stock market. Send them over to Josh. Non-owner HELOCs. It's like unheard of. Like no bank does that, right? The banks they don't want to touch that. It's like taboo, right? And so that's great. This is new, right, Josh?
Yeah, this is new. They've been talking about it for a while, but it did finally come out and launch, and it's like ready to go. And I've got one working right now. So we'll keep you guys posted on how that goes. wanted to go ahead and open it up for any questions. If anybody had any questions and wanted to ask us anything, you can either Melissa will definitely keep you posted on that. And so if anybody has any questions, want to either unmute yourself or type it in, let us know. Also too, we're open for meeting topics. Like Chris said, we want to make this more of a regular thing. Keep you posted on what's happening within the market, the overall real estate market, the mortgage market. You know, just have this as an opportunity for us to get together, brainstorm, come up with ideas on how to get some deals put together.
We'll set one up for 2 weeks from now. We're going to talk about assumable loans, VA and FHA. If you have listings right now, when you take those listing appointments, you should ask them what kind of mortgage they have. Because VA and FHA are assumable. I'll get more into it because it's a whole 30-minute call of explaining it. And that one will be more interactive because everyone's gonna have questions on that. So, hey, I think no one has questions. I'm ready. Oh, there's a question. Oh, this is fantastic. Thank you. All right, cool. All right.
All right, guys. Thank you so much for joining us. We really appreciate it. And we'll talk soon.